Asset accounting is a specialized subledger within the financial accounting system. It focuses on tracking and managing a company's fixed assets throughout their useful lives. Fixed assets are tangible resources that a company owns and uses for an extended period, typically more than 1 year. Examples include buildings, machinery, vehicles, and computer equipment. Asset accounting plays a crucial role in financial reporting and decision-making. One of the primary goals of asset accounting is to accurately reflect the value of fixed assets on the balance sheet. This involves recording the initial cost of assets, tracking any subsequent expenditures, and systematically allocating the cost of the asset over its useful life through depreciation. By accurately recording and depreciating assets, businesses can determine the true cost of using those assets in their operations. Asset accounting also helps organizations comply with accounting standards and tax regulations. Accurate asset records are essential for financial reporting, audits, and tax filings. Failure to maintain proper asset accounting practices can lead to financial misstatements, penalties, and reputational damage. Overall, asset accounting provides essential information for internal and external stakeholders, enabling informed decision-making and ensuring compliance with relevant regulations. The chart of depreciation is a fundamental element of asset accounting. It serves as a blueprint that defines how depreciation is calculated for different asset classes. The chart outlines the specific depreciation methods, useful lives, and other parameters that determine the annual depreciation expense for each asset category. The purpose of the chart of depreciation is to standardize the depreciation process within a company. By establishing predefined rules and guidelines for different asset types, the chart ensures consistency and accuracy in depreciation calculations. This consistency is crucial for generating reliable financial statements and making informed business decisions. For instance, a company might have separate depreciation areas defined in the chart for buildings, vehicles, and office equipment. Each area would specify the applicable depreciation method, useful life, and other relevant parameters for assets within that category. The chart of depreciation simplifies the depreciation process and ensures that all assets are depreciated according to a predetermined plan. Depreciation methods are systematic approaches to allocating the cost of an asset over its estimated useful life. The choice of depreciation method can significantly impact a company's financial statements and tax liabilities. Two commonly used depreciation methods are the straight-line method and the written-down method. The straight-line method is the simplest and most widely used depreciation method. It allocates the cost of an asset evenly over its useful life. To calculate straight-line depreciation, you divide the depreciable cost of the asset, cost minus salvage value, by the asset's useful life in years. This method results in equal depreciation expenses each year. The written-down method, also known as the declining balance method, allocates a higher depreciation expense in the early years of an asset's life and a lower expense in later years. This method reflects the idea that assets tend to lose value more rapidly in their early years. The written-down method is often used for assets that become obsolete quickly or experience rapid technological advancements. Section 4. Asset classification and number ranges. Asset classification and number ranges are essential aspects of asset accounting that facilitate efficient asset tracking and management. Asset classification involves grouping similar assets based on their nature, use, and characteristics. This classification system helps organize asset data and simplifies the analysis of asset-related information. Number ranges, on the other hand, provide a structured way to assign unique identification numbers to individual assets. Each asset class is assigned a specific number range, and each asset within that class receives a unique number within that range. For example, a company might classify its assets into categories such as land, buildings, machinery, and vehicles. Within each category, specific number ranges would be assigned, such as 1,000 to 1,999 for buildings, 2,000 to 2,999 for machinery, and so on. Asset classification and number ranges streamline asset tracking, simplify reporting, and enhance the accuracy of asset-related data. Section 5. Advantages and disadvantages of asset accounting. Asset accounting offers several advantages for businesses, including improved accuracy in financial reporting, better asset management, and compliance with tax regulations. By meticulously tracking asset costs, depreciation, and other relevant information, Asset accounting ensures accurate financial statements that reflect the true value of a company's fixed assets. Furthermore, asset accounting enables businesses to effectively manage their fixed assets throughout their life cycles. By tracking asset locations, maintenance records, and depreciation schedules, companies can optimize asset utilization, minimize downtime, and make informed decisions regarding asset disposal or replacement. However, asset accounting can also present some disadvantages. It requires meticulous record keeping, which can be time-consuming and resource-intensive. Implementing and maintaining an effective asset accounting system may involve significant upfront costs, including software, training, and ongoing maintenance. Despite these challenges, the benefits of asset accounting far outweigh the drawbacks, making it an indispensable aspect of sound financial management for businesses of all sizes. Section 6. Organizational units and typical accounting entries. In asset accounting, organizational units play a crucial role in segregating and managing assets based on their location, department, or responsibility center. Organizational units allow companies to track asset performance and allocate costs more effectively. For example, a manufacturing company might have separate organizational units for its production plant, warehouse, and administrative office, each with its own set of assets. Typical accounting entries in asset accounting include recording the acquisition of assets, tracking depreciation expenses, and accounting for asset disposals. When an asset is acquired, its cost is recorded as a debit to the appropriate asset account and a credit to cash or accounts payable. Depreciation expense is recorded periodically as a debit to depreciation expense and a credit to accumulated depreciation. When an asset is disposed of, its cost and accumulated depreciation are removed from the balance sheet, and any gain or loss on disposal is recognized. These accounting entries ensure that asset values are accurately reflected on the balance sheet and that depreciation expenses are appropriately recognized in the income statement.